Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I am going to talk to a close friend of mine now, Eng Taing. Eng is the CEO and founder of Touzi Capital and is an experienced real estate investor with over $100 million worth of assets under his management. Actually, I didn't know that Eng is an economist by training from Wharton School of Business. That's great. And he also has experience leading data science and analytics at Apple, Capital One, AT&T, etc. Also, I can relate to another fact because not that, we both come from IT, Silicon Valley world, but we both have immigrant story, right? So he's also a classic immigrant story, born in a refugee camp in Thailand, escaping a war and finding success in data and math in America. So welcome, Eng.
Thanks for having me, Alpesh. Glad to be here.
Absolutely. So yeah, I already spilled the beans about something interesting about yourself. So can you talk something funny or interesting about yourself?
I went to the Peace Corps after the financial crisis, which I kind of helped cause because if you're in finance in 2007, you were instrumental in booking I booked like $4 billion of subprime assets. And I went to Peace Corps, I think where most of my friends went to the MBA, and I met my wife there. So she was volunteering abroad at the Republic of Georgia.
That's great. So let me ask you about this because you did, Wharton School of Business and you went through all these big corporations. Why did you retire from Apple?
Because I could. And
that's a good answer.
That was one of the things that after the financial crisis and going through that cycle, and I was always really good at trading stocks, and I still invest in stocks, but I don't trade anymore, and I don't like the volatility of it. And so when I saw that real estate became very good from a numbers perspective, because I saw that it went down to a third of its value in 2008. I was like, should I buy this? Because now I have a little bit of money left over selling my stocks and could buy it and get cash flow, significant cash flow in that time. And it was like pretty predictable. And that allowed me to continue to do other things and take risks and go Peace Corps, do different jobs, ask my boss and employers for more compensation, counter offer, etc. Things that wouldn't be necessarily possible if I only had that,
Right. No, that's a great point. So I keep telling everyone, you got to build multiple streams of income. Once you have that, then you can, go back and negotiate with your boss, maybe ask for compensation, maybe say that I'll only work from home, right? And you can always do a side hustle. So there are lots of ways for you to negotiate. So let's you retired from Apple, but did you have a number in mind, either number of properties or certain income per month when you were thinking about retiring?
I wanted to replace my Apple income, which was significant.
Yes.
And I did. And I did it in a tax advantage way, right? So for those who listen to this podcast a lot, they probably know that real estate investing is very tax advantage. You almost never, or if you do it right, pay taxes on the cash flow. So it's not the same. You got to make $500K and then you make $500K of passive income. Like you don't make that much.
No.
So getting that same net benefit was easier, and through some luck and compounding and doing it, buying properties every year for 12 years, I achieved it at 35.
That's awesome. So why and when did you start with real estate exactly? What time is 2008?
2008, and then I bought my first property and bought my first triplex. It was $126,000. I remember very clearly. I bought it for 25% down. I did a rehab paint job, and I took out around $50,000 in 6 months. So more than I put in, and then I bought another one. So
Nice.
that was a good learning. It was before I even knew what BRRRR method is. And I was hearing what
Yeah.
BRRRR method is. Like, I don't know what that is. Like, oh, I've been doing that.
That's exactly what happens, right? Of course, the bigger pockets guys have, put a word around it and made it attractive. But a lot of us have been doing this, right? Even the house hacking word, I've heard, some of my guests, they have done it like 15, 20 years ago. But now, bigger pockets calls it as hacking or BRRRR method. No, that's
Yeah.
so that's awesome. So can you take us through the process you went through to get to the point of retiring? Like, you started in 2008. Did you then put a plan together, or do you have a process in mind?
I don't think I had a process in mind. And I think if it wasn't for some circumstances, the pandemic and other things, I probably would still be working. I think some things forced my hand a little bit earlier than I wanted, but it actually became the best thing. And in fact, I kicked myself like I should have done it earlier. I was having a baby at the time, and I have another. So he's 4 months old now, and I wanted to maybe just go through, get the paternity, have that. For me, I have always been investing in real estate every year, whatever I've been doing. And, for a while, I stopped buying in California. I bought from California from 2008, 2015, and it barely made sense in 2015 because I invest for cash flow. There certainly a lot of people who make money off appreciation. And if you buy in 2015 in Palo Alto or, other places in the Bay Area, you probably made quite a bit of money in Cupertino. But you're not getting cash flow. And so the cash flow was really a big component of my financial freedom. And so, it was all about not necessarily getting to a number because I've lived off less. It's more about getting to a sense of this can continue indefinitely. This could be my career. This could be my passion, it is my passion. It has been my passion, but I could scale it. If I put more time into it, I could do more. So that's why it made sense for me to leave. And it was hard to do it leaving Apple. You get, these are the kind of companies, for the most part, people go to retire. People go and get really nice RSUs. They get them every year, every half year sometimes, and they keep vesting every quarter or whatever it is for whatever company. And they are some of the most profitable companies in the world. And no matter how hard you work, it might not matter as much what your stocks or your compensation is, because that's really dependent on how much iPhones you sell or how much stock buybacks there are. Right. So those are things that felt a little bit out of my control. So for me, real estate investing felt more in control. So when I bought real estate, I've always bought for cash flow. I bought for 12%, bought for 15% cash and cash. And this, in addition to luckily having appreciation, which wasn't always something I banked on, it was just something that happened because real estate as an asset class just kept going up. That cash flow allowed me to compound, take money out, tax-free, build a pool, buy another thing, and keep doing it and compounding, and then keep scaling up. And my biggest learning is that I probably should have scaled up faster from buying a triplex to 5 triplex, 10 triplex or quadplex was very unscalable.
Right.
Every residential loan, this takes a long time.
Yep.
They get explained what an RSU schedule is, you get explained all these other things. And once you're out of an income like I am now, no W-2 income, it's hard to get a loan.
It's very difficult. I was just trying to refinance and it was painful.
Yeah. I know. My friend just got a 1.875 rate with a W-2 income. Now I can get a 3% rate, maybe 2.8% rate on commercial loans. And it's very easy and it's very scalable.
It's very easy.
$10 million loan. Yeah.
Yeah, I was just this morning, I was talking to a friend and we discussed the same thing because both of us are self-employed. And even though I have been running the business for 10 years, I barely got 2.875% and the residential, but commercial, we can get the loan in and out any day. So it was, it's a huge difference. Hey, so let's talk about this. You started investing in 2008 and you retired, my understanding is last year.
Mhm.
Um, so, what mistakes did you make through this journey?
I think the biggest mistake has been not partnering earlier, and trying doing it all yourself. I think it's, you probably know this, it's a team sport, and that's why
Yes.
we team up sometimes, and we'll team up some more, partner some more, and there, trying to do it yourself means you're thinking very limitedly, because when you're like an immigrant like me, like us, we grew up very little potentially, and you
Yes.
want to always keep everything, and so you don't want to pay more people. You want to do this, you want to do it
Exactly.
all yourself. But then you don't think about your time, and you don't think about
Yeah.
that. If I do this, I can actually make it a business, and I could do more of it, and focus my time and efforts on what's high value. And so, if you think about every deal as sort of, this is the only deal that I will ever do, and this is the only things I will do, then of course you want to minimize expenses. You want to
Yeah.
minimize
Yeah.
everything. But if you think this is just one of many,
Yes.
and this one of many will help make the second one better, that building the first iPhone is expensive, but the millionth iPhone is cheaper,
Yes.
then you think differently, you think abundantly. And for me, doing it on my own first time, learning a lot, yes, but I could have learned with less financial mistakes. I could have retired maybe at 33, but it's okay. I think these are things that, as even I do go into Touzi Capital now, I'm learning every day.
That's a great point, though, and I can 100% relate to this, right? And you and I are partnering as well, and we'll talk about that as we move forward in the episode. But yes, as an entrepreneur, we have been taught that we have to wear multiple hats. But
Mhm.
no one is telling us that when you got to start removing those hats or handing over the hats to other people so that you can focus on the things which matter the most, right? And I think yeah, as I said, I'm struggling. Actually, right before our podcast, I was talking to a couple of my VAs. I'm trying to offload as much as possible. So yeah, so that I can focus on my business.
Mhm.
What was your best real estate investment so far?
I think yeah, to be honest, I think my first investment has been one of the best ones, because first of all, it got me started in it, but also was an out-of-state investment. It wasn't like
Oh,
local.
okay. You
I,
did that
I,
in 2008.
yeah,
Wow.
2008, because I was living in DC at the time,
Oh,
and living in the East Coast, and I wanted to buy near where I grew up, which is in LA. I knew the area very well. I knew this location was good, but I had to manage across the
right.
states, and it helped me understand how to make that work. And when I bought properties, even when I was living in LA, living locally, I would still make it a process where I didn't have to visit every month, every few months even. And this allowed me to understand things from a mathematical perspective first, and then from an emotional perspective. Because yes, real estate can be emotional, but you don't want to have to like have that taint your opinion of things. The first one was really good too, because I refinanced it like 4 times. I think I treat like my bank account. It just keeps growing and keep getting money out. It's great. Get cash flow. It's amazing.
Oh, that's awesome. Did you have any worst real estate deal? Or if there was one, can we talk about it?
Yeah, no, I think one of my other big deals in Touzi Capital has been not as good, and that's mostly because I've had to spend a lot of time on the partnership side of things. So
Ah,
partnerships can be good, but also can be challenging when
yes.
you don't have the same,
Same goals
growth.
and same mindset.
Exactly. Yeah. If everyone is trying to just look out for number one, that's not, you really got to look out for number one, the investor.
Yes.
And so if everyone has the same mindset, I think it works out. In that case, it just spent more time. I believe I think it's on track to send all distributions and send all track to make the money, but it could be smoother, right? You always think about things from time perspective as well, not just returns. How can you scale your time?
Yes. No, that's awesome. What are you currently investing in and why?
I'm focusing a lot on tax advantage cash flowing investments. And for me, that has been before multifamily. But then it became a little bit harder. And I still look for those deals. I was in Kansas City recently looking for it, but the cap rates are lower and
Yes.
so much
And
capital out there.
competition is so high.
Competition is high. I don't like to compete in crowded markets. I don't think anyone should. So when I look into something like senior living, senior housing,
Yes.
which I believe you're a fan of as well,
Yep.
it's a moat because people aren't doesn't understand it. It's HR, it's complex operations. If you have the right partner, you can solve for that. But not everybody will just put money into it. And so the cap rates are 2-3 points higher on stabilized. The IRRs are 5 points higher on value add. There are still value to be had, and the demographic changes are significant. So that's real estate. I also look at every other thing, like Bitcoin mining is something that I really love. And so these are kind of things that I like to think about, like from a, how can I learn it? How can I simplify it? How can I neutralize or de-risk it? And then put my own money into it. And then potentially, if it works out, invite my investors to potentially invest.
That's great. And both of these asset classes I love. I keep harping on the fact that I focus on mobile home parks, which is affordable housing, and senior
Yes.
housing is what I love because that population is booming. The baby boomers would be the largest population base by end of 2023.
Mhm.
And of course, the third thing is because you and I come from IT, we like to dabble in cryptos, right? So, but we focus on multifamily to senior housing, and you mentioned Bitcoin mining. And again, I want to put a disclaimer. Yang and I have partnered on that particular deal, and we are not supposed to advertise, so we are not advertising at all here. But can you talk more about what do you mean by Bitcoin mining?
Yeah, when I think about Bitcoin mining or investing in Bitcoin and crypto in general, you're investing in a potential future where the reserve currency of the world is Bitcoin,
Right.
where it is replaced, denominated by Bitcoin. And that's how every CFO is approaching it. That's how all the major institutions are approaching it. And I think it's the right time to get into it. But when I invest in Bitcoin, I don't invest in stocks individually as speculatively as my other friends do who have made a lot of money, to be fair. And I can't compete against that with my real estate. My real estate is hitting singles and doubles, getting solid double-digit returns, not really, going for home runs, but trying to make consistent compounding tax advantage growth. And so for Bitcoin mining, it felt a little bit like that because you could have a predictable mathematical equation to get cash flow in the form of Bitcoin, depreciation in the form of bonus depreciation of mining equipment, hardware, computers, and a very predictable life cycle of these things happening. So it felt somewhat similar to real estate. And I love the overall trends because I don't know about you, but I see the quantitative easing. I see the money supply that all plays into assets rising. Assets
Yes.
include stocks, but also real estate because capital is
Everything.
flowing into it. And that also means that dollar inflation will happen and your dollar will go down, and everything means that on a fixed quantity supply of Bitcoin, it becomes a more valuable asset. So with everything that the government is doing, essentially is playing into the fact that I want to get as many long-term loans as possible, because if I borrow $10 million now, it will be worth less in 5 years,
Yeah,
worth less in 10 years. I mean, how much could 10 million go from 10 years ago or 30 years ago to a 30-year loan? Like, you want to keep just getting loans because that interest rate is so low. And Bitcoin and assets all appreciate in that spectrum. So at the very least, I'm playing into the same macroeconomic strategies that will just be sustaining these investments. So I just like to have at least some tailwinds when I invest, and that's why these strategies are very good.
No, that's a great explanation, right? And I like the word you use, consistent compounding returns, right? That's why we don't try to time the market in real estate or in stocks, because I want to get the same cash flow every month. I want to know that this is what I'm getting. That's the only way you or I can retire from our day job. And the second thing about Bitcoin mining is what you mentioned is we have America and even the rest of the world are printing money like crazy. What that tells me is that we have infinite money, but Bitcoin is finite. It's 21 million no matter what. You can I jump as much as we want if we want to mine more, but it will always be 21 million unless miners around all over the world get together and update the code, right? So that's not possible. So that's where supply and demand comes into picture, right? Whenever the supply is going to be scarce, the demand will always skyrocket. So it's a simple math.
Yeah, it's a simple math. And I love industries that have both tax advantages, cash flow, as well as need capital to make it grow. And Bitcoin mining is one of those industries that needs capital that makes it go. And the interesting thing is like last year, Bitcoin was at X. Now it's at 10x or 8x, whatever it is. But the number of miners, which dictates how much Bitcoin, you can only mine so much Bitcoin at any time, didn't go 8x, didn't go 10x. It only went 2x. And there's a ship supply, there's a shortage of it. It can never grow more than Bitcoin price in most cases, because dollar is just so, if they print more money, as companies and rich people essentially get more of it, they will just put money into Bitcoin, driving up the prices. But you can't put more money into getting more miners because there's a chip supply shortage. These are global supply constraints that, so I love buying into constraint industries.
Yeah, no, and I can attest to the supply constraint as well, because right now when we started talking, the miners are about 6 to 9 months out. So you place an order right now, it would take about 6 to 9 months. And so that's why we will always be in good space if you plan it out and you have the miners ready to ship for us, right? So this is great. Hey, another question, because I ask everyone, what do you think about now at this point, stock market, real estate, and cryptocurrencies, as all of them are at either near or all-time high?
They're all-time high, and I think they'll go higher.
Really?
Unfortunately, and I actually don't like that.
I don't like it.
I wish it was flat. I wish it was like steady. I think that creates exposure, but it's also financial assets, right? Financial assets do well in these kind of scenarios, in which most people don't have financial assets. Financial assets also are highly leveraged or highly inflated because of the last people buying it. Doesn't mean a company's worth something billions of dollars. It just means that the last person buying it bought it at a certain price, meaning everyone who owns it is valued at that price. But if 10 of the people who sold it, it will go down not by 10%, but by at least 50 to 60%. So those economics happen in financial instruments like stocks. I think what's happening right now is there's just so many people who have money who you're not going to get paid if you're a saver. You're losing money if you're saving in the bank. The bank is lending it to me. And at 3%, they're barely getting paid at all. But you're making 0%. So that's why saving does not help anybody. And people essentially don't become savers. They become investors. And more investors mean more capital. More capital means assets inflate.
Oh, that's another great point, right? So historical inflation rate is 2%, and the banks are not giving us 2% interest right now. So if you save money, you're already losing money. Your dollar is getting devalued every year. All right. So yes, that's a great point. Hey, Ang, this was great. Let's take a quick break. And after the break, we'll go through the same 5 questions I ask every guest.
You're listening to the Wealth Matters Podcast. The Wealth Matters Podcast. For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. I thoroughly enjoyed this discussion I had with Ang. Ang, are you ready for 5 round?
Yes.
Would you be changing any business or investment strategy after this pandemic is over?
I am feeling the optimism in the air. I mean, I was traveling outside California, where I invest almost all my money into, not in California. It just feels different. it feels things are opening up, feels things are, moving forward. And for me, the investment strategy is understanding the recovery. And the recovery is where senior living, for example, was hit in the
Yes.
coronavirus. And those leasing rates have gone down a bit. And that presents buying opportunities.
Yep.
I actually wish there was more buying opportunities in multifamily, but they just
There
kept
is
going
none.
up.
I was hoping.
Yeah, people didn't leave their residence, and people kept renting. And so I'm looking for those kind of opportunities to invest in, the strategies to invest in, those that will be rebounding.
That's great. Favorite real estate or finance or any other related book?
The biggest real estate book, of course, for everybody has been, the Purple Book.
Yeah, I was going to say
yeah.
Rich Dad Poor Dad.
Yeah, for me, I actually really enjoy. I really enjoy a lot of the textbooks.
Oh, really?
Yeah, because I think that highlights sort of the innate nature of real estate investing, right? It's government sanctioned tax advantage investing. It's the most insane thing that a piece of carpet can be depreciated 1,000 times. That doesn't make sense. So you buy it from me, you buy a building from me, the carpet is now go up in value. You can depreciate that, right? It keeps going again and again and again. And it doesn't make sense, but this is how it works. And the government helps and incentivizes people to keep investing, keep deploying your money, hopefully getting cash flow so you can get money out and invest more.
Yeah, no, and that's what I teach people, that the idea is that you get depreciation, but at the same time, you are getting cash flow, but you are not paying tax on that cash flow. So now, as with what you mentioned, compound your money, take that cash flow and reinvest, right? So your money starts compounding and working for you. And one of the book I love, it's The Tax-Free Wealth by Tom Wheelwright. Mm-hmm. That's what started me thinking when I read it in 2016. I'm like, this is what I like to do.
Yeah.
So any tool or website you recommend, or you use it almost every day for your real estate or investment purpose?
I used to use City Data a lot, City-Data a lot for analyzing micro markets. Nowadays, when you're an outsider, a California investor like us,
suckers,
you have to use data as much as possible.
Yeah.
But when you become an insider, when you invested in the market, you actually become more reliant on relationships and knowing things, path of progress, where the cable car is being built, where the new stadium is being built.
Yes.
Like, those things you find out when you're actually embedded in the community. So that's why I try to be as embedded in every community I invest in.
That's great. Any advice for beginner investors?
My biggest advice is to be flexible, to be adaptable. If you're thinking you're going into this to do one thing, understand that things could change, but have a North Star. And my biggest thing is that just do it. I think if you just start, if you get the feeling of it, if you're partnering with somebody, it's better. But if you're doing it yourself, that's fine. So many ways to skin a cat. I don't know why people say that, but so many ways to create wealth, to invest in real estate. Investing with us, investing in yourself, investing with partnership, JV, whatever it is. It's so many asset classes, so many decent asset classes. You're going to learn a lot. Every failure will be a learning. And you're going to build your net worth. You're going to build your credibility, your track record. And that one of my favorite things about real estate investing is that it scales. Everything about it scales. Doing one thing helps the second thing. And the second thing helps the third thing. That's not true with a lot of things in life. This thing really does makes it so that you really just got to start.
That's the golden nugget right there. You got to start. And I attest to the fact that, yes, you may fail, but take it as a learning experience and move on. Mm-hmm. How do you give back?
I think my biggest thing is I wish I had a lot of this advice earlier in my career in investing, and I try to do a lot of mentorships. So I try to mentor folks who are passionate about this. So I mentor some people in their careers on real estate investing, trying to find as a side hustle how to achieve that financial freedom earlier than potentially I did. But also just understanding that just having having that knowledge base does give you a little bit more just confidence to do it. So I try to provide, both for my family, but also help a lot with other people who just ask.
How can my listeners reach out to you?
Feel free to reach out to me at Eng, E-N-G, at Touzi Capital, Touzi capital.com, or go to my website, touzicapital.com. Always happy to chat. Love talking about taxes. Love talking about real estate investing and any kind of investments.
As always, great chatting with you, Eng. Thank you.
Thanks for having me.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!